Welcome to our podcast on Accounting Standards Update number 2014-18, Accounting for Identifiable Intangible Assets in a Business Combination. In this podcast, we'll go over the private company accounting alternative under ASU 2014-18, including reasons for issuing the alternative, the in-scope transactions the alternative should be applied to, and the application of the alternative itself and its interaction with the previously issued goodwill accounting alternative. My name is Brandon Cano, and joining me in this podcast is Paul Fayyad, and we are both senior managers in KPMG's Department of Professional Practice. Let's first start with a background discussion on the primary reasons why the Private Company Council, or PCC for short, issued the alternative. So this was actually one of the first issues added to the PCC's agenda back in February 2013 based on feedback from private company stakeholders indicating that they incur significant costs in their efforts to separately identify intangible assets acquired in the business combination because they generally need to seek the assistance in valuing these intangibles from external professionals such as evaluation specialists. And these stakeholders also cited that the benefit from valuing these intangibles did not justify the related costs. And although stakeholder views were mixed with respect to the usefulness and relevance of the fair value of intangible assets acquired in a business combination, they often had similar views of what they found most relevant, which were intangible assets that are legally protected, separately transferable, and capable of providing discrete cash flows. Those intangible assets that didn't fall into any of these categories were generally viewed as being complex to value. So based on this feedback and research analysis performed by the FASB staff, the PCC was able to narrow down the eligibility as to which intangible assets would qualify under the accounting alternative. Now that we have a little background on why the alternative was issued, Paul, perhaps you can take us through what transactions the alternative should be applied to.
Sure, Brandon. So when a private company elects the accounting alternative, it will do so for all in-scope transactions. All in-scope transactions are 1. When applying the acquisition method for a business combination. 2. When assessing the nature of the difference between the carrying amount of an investment and the amount of underlying equity and net assets of an investee when applying the equity method. And 3. When adopting fresh start reporting upon emergence from a Chapter 11 reorganization.
Thanks, Paul. While business combinations will likely be the most common situation, it's good to be aware of the other two circumstances in which the alternative would be required to be applied, as the alternative is applied to all in-scope transactions and not on a transaction-by-transaction basis. Let's now move on to the intangible assets that are eligible for the alternative. Private companies electing the alternative will not recognize separately from goodwill two types of intangibles. One of those is customer-related intangibles, unless they are capable of being sold or licensed independently from other assets of the business. And the second intangible asset that will not require separate measurement are non-competition agreements. So basically, if an entity has intangibles that fall into one of these two buckets, instead of recording them separately on the balance sheet, they will get subsumed into goodwill. Some examples in the ASU of customer-related intangible assets that may require separate recognition, that is, they are not eligible for the alternative and therefore will continue to be recognized separately from goodwill, include mortgage servicing rights, commodity supply contracts, core deposits, and customer information.
Brandon, you mentioned earlier that this accounting alternative has an interplay with the previously issued goodwill alternative. Can you tell us a little bit more about that?
Sure, Paul, I'd be happy to do that. The interplay with the goodwill alternative is that a private company that elects the accounting alternative for accounting for identifiable intangible assets in a business combination is also required to adopt the previously issued goodwill alternative. The reason for this is that the FASB and PCC didn't think it was appropriate to allow finite-lived intangible assets to be subsumed into goodwill without amortizing goodwill as well. Their concern here was that there could be a higher risk of goodwill being impaired when goodwill included these intangibles but was not amortized. So in applying the goodwill standard, first, new goodwill arising as a result of an in-scope transaction must be amortized. To put that into context, let's say an entity has its first business combination on June 1 and elects ASU 2014-18, which when applied results in eligible customer-related intangible assets associated with the business combination being subsumed into goodwill. The goodwill recorded as part of that business combination, which includes the customer-related intangibles, will be amortized over a period of 10 years, or a shorter period if one can be justified, beginning on June 1st. And maybe what I should also mention here on the amortization period is that under the goodwill alternative, an entity does not need to support why a 10-year amortization period is appropriate, nor is it required to evaluate whether a period of less than 10 years is appropriate. However, if an entity decides it wants to amortize goodwill for a period of less than 10 years, then it would need to have a basis to support that decision. Secondly, existing goodwill associated with previous transactions should be amortized prospectively as of the adoption of ASU 2014-18. So basically here, any goodwill on the balance sheet prior to the period of adoption of ASU 2014-18 will also be subject to amortization beginning in the period of adoption. So in general, if your period of adoption is an annual period, you'd look back to see what existing goodwill was on the balance sheet at 1/1 and amortize goodwill for the full year. The last thing I want to mention is that while the adoption of ASU 2014-18 requires the adoption of the goodwill alternative, a private company that has previously adopted the goodwill alternative under ASU 2014-02 would not be required to adopt the alternative for accounting for identifiable intangible assets in a business combination under ASU 2014-18.
So Brandon, now that we know how the alternative works, can you tell us when private entities can start taking advantage of the alternative?
Sure, of course. The alternative is applied prospectively to the first in-scope transaction occurring during fiscal years beginning after December 15th, 2015, and interim and annual periods thereafter. Because it is applied prospectively, customer-related intangibles and non-competition agreements that exist as of the beginning of the period of adoption shall continue to be subsequently measured in accordance with existing GAAP and should not be subsumed into goodwill upon adoption. The FASB and the PCC also decided to allow for early adoption for any financial statements that have not been made available for issuance. So with that, we'd like to thank you for joining this podcast today. We hope that the information provided gives you some insight on ASU 2014-18. We would also like to inform you that you can find additional information on this accounting alternative and other private company accounting alternatives issued by the FASB and PCC through our Defining Issues publications on the Financial Reporting Network website, which is also where you can find additional podcasts and thought leadership publications on a host of other accounting topics.